Silver is once again drawing global attention, but not because of flashy headlines or sudden price spikes. Behind the scenes, quiet forces are reshaping the silver market. Industrial demand is rising, global supply is tightening, and powerful players are making long-term strategic moves that most people never see. At the same time, the rules of the market itself, especially margin requirements and futures trading, are changing how prices behave. Some analysts believe these forces could eventually push silver toward levels once considered impossible. In this documentary, we take a calm and structured look at what is really happening. We will explore how China is quietly securing silver supply, what a margin increase actually means, and why it matters how industrial demand is changing the balance, what history tells us about silver price resets, and whether a path toward $100 silver is realistic or exaggerated. No fear. No exaggeration, just clarity. For most of modern history, silver was treated as a secondary asset, often overshadowed by gold and dismissed as a volatile cousin in the precious metals world. That perception is now quietly breaking down. Silver today sits at the intersection of finance, industry, and national strategy, and this shift changes everything about how it should be understood. What makes silver different is not speculation, but necessity. Silver is one of the most electrically conductive metals on Earth. That single property makes it indispensable to modern life. Every solar panel relies on it. Every electric vehicle uses it. Smartphones, medical devices, data centers, military communications, and advanced electronics all depend on silver in ways that cannot easily be substituted. Unlike gold, silver is not simply stored and admired. It is consumed, embedded, and often lost forever once used. Here is the part many people miss. As the world pushes toward electrification, green energy, and digital infrastructure, silver demand is not optional. It is structural. Governments can debate policies, but factories still need silver to function. Mines, however, do not respond quickly. New silver supply takes years to develop, and much of global production is a byproduct of mining other metals. That means supply cannot simply surge when demand rises. This creates a quiet tension beneath the surface. While financial markets trade silver as a short-term instrument, the physical world treats it as a long-term requirement. That gap matters. When an asset shifts from being desirable to being essential, pricing behavior eventually changes. Another overlooked reality is how little silver exists above ground compared to its role in the global economy. Large stockpiles once held by governments have been steadily drawn down over decades. At the same time, industrial use has expanded into areas that did not exist a generation ago. This is why silver is no longer just an investment story. It is a story about infrastructure, technology, and the physical limits of supply meeting a rapidly changing world. When those forces align, markets are often the last to fully react. China's approach to strategic resources has rarely been loud or theatrical. Instead, it has been deliberate, patient, and long-term. Silver fits squarely into this pattern. While global markets focus on daily price movements, China has concentrated on control, access, and resilience. The hook is that this strategy does not depend on driving prices higher in the short term. It depends on ensuring availability when others discover it is scarce. Over the past 2 decades, China has invested heavily in domestic mining, refining, and recycling capacity. This reduces dependence on foreign supply chains and shields key industries from external shocks. Silver is essential to China's manufacturing ecosystem, especially in solar energy, electronics, and advanced technology. These sectors are not optional growth areas. They are pillars of national policy. Securing the metals that power them is a matter of economic stability. China has also expanded its influence beyond its borders. Through long-term supply agreements, overseas mining investments, and partnerships across Asia, Africa, and Latin America, it is quietly locked in future silver flows. These arrangements rarely make headlines, yet they reshape how much silver is freely available on global markets. When supply is spoken for years in advance, the remaining pool becomes thinner than prices suggest. Another key element is stockpiling. China does not publish detailed data on its strategic reserves, but history shows a consistent pattern. Whether oil, rare earths, or base metals, accumulation tends to occur during periods of low prices and public disinterest. Silver appears to follow the same logic. The hook here is subtle. When a nation buys quietly, it avoids drawing attention to the value of what it is securing. This strategy does not aim to corner the market or trigger sudden price spikes. It aims to remove vulnerability. By the time shortages become visible to the wider world, positioning is already complete. Markets often react late to structural shifts because they focus on signals, not intentions. China's role in silver highlights this gap between what is seen and what is being prepared. Most people assume that the price of silver is determined by how much metal is being bought and sold in the physical world. The reality is far more abstract. Silver prices are primarily set in the futures market, where contracts representing silver are traded in volumes that dwarf the amount of metal that actually exists. The hook is that the global price of silver is shaped less by metal and more by expectations. A futures contract is an agreement to buy or sell silver at a specific price at a future date. These contracts were created to help producers and consumers manage risk. Over time, they evolved into highly liquid financial instruments. Today, the vast majority of futures contracts are never settled with physical delivery. They are closed out, rolled over, or settled in cash. This means silver can be traded many times without a single ounce moving. This system creates what is often called paper silver. Paper silver includes futures, options, and other financial products that track silver's price without requiring ownership of the metal. In theory, this adds efficiency and stability. In practice, it allows the paper market to expand far beyond the physical supply. The hook lies in scale. On many days, the amount of silver represented by contracts traded exceeds global mine production for an entire year. As long as participants are confident that contracts can be settled, the system functions smoothly. Prices respond quickly to economic data, interest rates, and market sentiment. But this structure also means prices can move sharply based on financial flows alone, even when physical demand remains strong or supply tightens. The deeper issue emerges when confidence shifts. If more participants decide they want delivery instead of cash, pressure builds rapidly. The system was never designed for mass delivery. It was designed for liquidity. This is not a flaw, it is a feature, but it creates a fragile balance between trust and reality. The hook is subtle but powerful. When the price of silver is set in a market where metal rarely changes hands, price signals can drift away from physical conditions. Understanding this gap is essential because it explains why silver can feel simultaneously abundant on screens and scarce in the real world. One of the least understood forces in the silver market is the role of margin requirements, yet their impact on price can be immediate and dramatic. A margin is the amount of money a trader must deposit to control a futures contract. It is not a payment for silver itself, but a performance bond designed to limit risk. The hook is that a simple change in this requirement can move prices more forcefully than any shift in supply or demand. When margin requirements are low, traders can control large positions with relatively small amounts of capital. This attracts speculative money and increases trading volume. Prices may rise quickly as leverage amplifies momentum. When volatility increases, exchanges respond by raising margins to protect the system from excessive risk. In the case of silver, these increases have sometimes been sharp and sudden, with margin levels jumping by thousands of dollars per contract. A move toward a $25,000 margin fundamentally changes behavior. Traders who cannot add more cash are forced to reduce or close positions. This selling pressure can push prices down rapidly, even if nothing has changed in the physical market. The hook is that these price drops often look like a loss of interest or demand, when in reality they are mechanical responses to new rules. This pattern has appeared repeatedly in silver's history. During periods of rising prices, margin hikes have coincided with abrupt reversals. Critics argue this suppresses price discovery, while exchanges maintain that risk management is essential. Both perspectives can be true at the same time. The rules are neutral, but their timing matters. What makes silver particularly sensitive is its relatively small market size. Compared to equities or currencies, silver reacts more sharply to changes in leverage. A margin increase removes fuel from the market almost instantly. The psychological effect compounds the move, as traders interpret falling prices as a signal to step back. The hook is not about blame, it is about understanding structure. Margin changes do not reflect the value of silver, they reflect the tolerance for risk within the trading system. When viewers see sudden price drops without obvious reasons, margin mechanics are often the hidden force behind the move. Silver's price behavior has never followed a smooth or predictable path. Instead, history shows long periods of quiet consolidation followed by sudden, explosive moves that catch most observers off guard. The hook is that silver rarely signals its intentions in advance. It moves when pressure has already built beyond what markets can comfortably absorb. In the 1970s, rising inflation and a loss of confidence in paper currencies pushed investors toward tangible assets. Silver prices climbed steadily at first, then accelerated rapidly as fear spread through financial markets. The final surge was not gradual. It was abrupt, driven by a rush to secure real assets before purchasing power eroded further. When the move ended, it ended just as violently, leaving behind a lesson about how quickly sentiment can reverse. Decades later, a similar pattern emerged during the global financial crisis. Massive monetary stimulus and near-zero interest rates revived interest in precious metals. Silver again lagged behind gold at first, then surged sharply as investors searched for alternatives to traditional assets. Once confidence stabilized and rules tightened, momentum faded. The cycle repeated, even though the underlying financial stresses had not fully disappeared. What these episodes share is not price level but structure. Silver tends to remain undervalued while pressure accumulates quietly. Industrial demand grows. Investment interest builds slowly. Monetary conditions loosen. Then, when a tipping point is reached, price adjusts rapidly rather than smoothly. The hook lies in timing. By the time silver is widely discussed, much of the move is already underway. History also shows that silver's moves are often constrained by market mechanics during the early stages. Margin changes, regulatory responses, and shifts in liquidity can temporarily cap advances. These interventions do not remove pressure, they redistribute it over time. Understanding silver through a historical lens shifts expectations. Instead of asking why silver is not moving today, the more useful question becomes how much pressure is building beneath the surface. History suggests that silver does not respond to impatience. It responds to imbalance, and when it does, it rarely does so quietly. A silver price of $100 an ounce often sounds extreme because it is framed against recent history rather than long-term context. The hook is that this number only feels unrealistic when viewed in isolation. When examined through broader economic lenses, it becomes a question of conditions rather than imagination. In nominal terms, silver has already approached levels that seemed impossible at the time. When those past peaks are adjusted for decades of currency expansion and inflation, the equivalent price today rises substantially. This does not imply silver must return to previous highs, but it does reveal how much purchasing power has changed while silver's price has lagged behind. Another perspective comes from relative valuation. For centuries, silver and gold moved in a relatively stable relationship, reflecting their shared role as monetary metals. Today, that relationship is stretched far beyond historical norms. Such extremes do not dictate outcomes, but they highlight imbalance. The hook is that markets rarely remain permanently skewed without some form of correction. Supply dynamics add further context. Silver production has not kept pace with industrial demand, and mining costs continue to rise due to energy prices, environmental regulations, and declining ore quality. Replacement cost models suggest that prices below sustainable production levels cannot persist indefinitely without affecting future supply. Over time, scarcity asserts itself. Monetary conditions also matter. The expansion of global money supply over recent decades has been unprecedented. Hard assets have historically served as reference points during such periods, adjusting upward as paper currencies lose relative value. Silver's muted response compared to other assets raises questions about timing rather than direction. The hook is not certainty, but probability. A $100 silver price is not a prediction, it is a scenario that depends on multiple variables aligning. What matters most is understanding that silver does not need hype to justify higher valuations. It needs conditions. If those conditions persist or intensify, prices once considered unrealistic may simply become a reflection of a changed economic landscape. For most people, silver discussions can feel distant, technical, or reserved for traders and institutions. The hook is that silver's movements eventually reach everyday life, often in subtle ways that are easy to overlook until they become impossible to ignore. This is not about speculation alone. It is about how shifts in the value of money ripple through ordinary decisions. When silver prices rise, it often signals broader changes in the financial environment. Inflation pressures may be building. Trust in paper assets may be weakening. These conditions tend to affect purchasing power long before they appear in official statements. Everyday costs rise, savings buy less, and long-term planning becomes more uncertain. Silver does not cause these changes, it reflects them. There is also an industrial side that touches daily life. Silver is essential in electronics, medical equipment, solar energy, and communication technology. When supply tightens or prices rise sharply, manufacturers face higher costs. These costs are eventually passed on through higher prices for consumer goods, even if the connection is not immediately visible. For individuals who hold savings, the discussion becomes one of resilience rather than profit. Silver has historically functioned as a store of value during periods of monetary stress. It does not generate income, but it also does not depend on the promise of a counterparty. The hook lies in its simplicity. It exists outside digital systems, balance sheets, and policy decisions. At the same time, silver is not without volatility. Prices can move sharply in both directions, often driven by forces that have little to do with personal circumstances. Understanding this helps avoid emotional decisions. The goal is not fear, but awareness. For ordinary people, the silver story is ultimately about perspective. It invites a closer look at how money works, how value is preserved, and how large financial shifts quietly shape everyday life, long before headlines catch up. Let's summarize calmly. Silver is now a strategic, industrial metal. China is quietly securing supply. Futures markets shape prices more than metal margin rules influence volatility. History suggests revaluations happen suddenly, not smoothly. This does not mean silver must reach $100. It means the current system carries tension. If this documentary helped you understand silver more clearly, like the video to support educational content. Comment below with your thoughts. Do you see silver as a metal, a signal, or both? And subscribe for more calm, fact-based documentaries that explain complex financial systems without hype. Because understanding markets is not about prediction. It's about perspective.